Robert, with the interest rate announcement due in less than 24 hours as we're recording this, it is Tuesday, July 23. Wednesday, July 24 is the interest rate announcement. We're expecting a turn of events, or are buyers going to be taking revenge this summer?
Okay, you know that I think it's buyer's revenge season. This summer is always a lull, and buyers who have the capacity to buy are sitting on the sidelines. They're looking and they're waiting, and if they are making offers, they're making terrible offers. A quarter of a point don't make no difference. The thing is consumer confidence. Buyers are now knowing that interest rates are coming down. Some people are even saying four junks or drops in 2024, BMO. Maybe they're right, but that's because bad news, economic news, is good news for dropping interest rates. So it's really a damned if you do and damned if you don't. So what are buyers going to do? They're going to do nothing until it's to their advantage. They observe it, that prices are going up, so they missed it, or interest rates are going up, so they missed it. But they know the interest rates are coming down, and they're hoping that by waiting and doing nothing, that prices will go down. But they're not.
And on this episode of Real Estate Chat with Robert Eid, and
John Deere Perez.
that's what we're going to be talking about. And for those of you who don't recall, make sure you like and subscribe so that you never miss episodes of Real Estate Chat. The most recent interest rate drop should have resulted in buyers jumping off the fence in crowds and droves, but they didn't. And what ended up jumping instead, which we'll review on Robert's charts, part of these details is inventory has shot up. Sales have dipped a little bit, but there is a little bit of good news that Robert will share about sales. But the most important thing for Real Estate Chat viewers is what's going to be happening in the next few weeks of summer and what should we expect in the fall. Let's jump to some of these charts here, Robert, that you're going to be sharing. Starting with the composite peak. Now, I know we've had some viewers, and thank you for watching, that have said that some of these charts are a bit difficult to navigate. So we're going to simplify it. We'll make it a little bit easier for you. Robert, why don't you explain like all of these squiggly lines going on?
Okay, squiggly lines. We say at the top that what we've taken is the prior peaks, in 1981, October in 1989, April in 2008, April in 2017, and February of 2022, and made them all 100. So they all coincide. And then we can see we borrowed this from Robert Hogue from RBC, who used quarterly, and he went about 4 months either side, 4 quarters either side, and adapted it to monthly and to the Toronto Real Estate Board only. He had national, it's the only numbers he had to deal with. So what we can see is the peak, and I made the red bold, which is the current situation that we're in. Then you can see there's a 1 year out, which was February 23, and then a 2 years out, which was February 24. Now, if we observe that red line from the 100 peak, it goes down. Well, everybody's saying, "Oh my, follow the red down." Well, is the world coming to an end? And then it surged up again in the spring of 2023 because everybody thought the world was not coming to an end, and both realtors who need to make sales and specs who need the market to go up said, okay, let's buy in again because it's going to go up. We can beat the market by buying in the first quarter. And so this is prices that we're looking at. Then the same thing happened again. We're in the summer of last year, things fell down again. And then at the end of the year, it was pretty lousy. And then in February, the same thing happened again. I call it a false rally. That people were expecting interest rates to come down. Everybody was saying interest rates are going to come down. And in anticipation of interest rates coming down, people bought specs who were not, when I say specs, I mean non-owner occupants. They're not living there. Bid up the prices again. I'll get this one before the spring rally goes. And then the spring rally sort of fizzled in the middle of May. And that's what we're in the middle of now. However, in order for there to be a price achieved, there's got to be both a buyer and a seller. If there are no buyers, then there's no change in the price because the seller doesn't capitulate in the face of nothing. It's only when the sellers capitulate. So we're going to see whether, okay, we go to this chart now. You got a blue line coming down, which is trying to line up the previous peaks into the future. Now, there's nothing to say that the future is going to be exactly the same in a straight line as the past. But if you did connect those up and you got a straight line to go like that. Now, the purpley line along the bottom is if you connect up the bottoms, the recent bottoms, and you get it's on a different slope and it comes out to somewhere around 5 years and somewhere around 75% of the previous peak. Now, is that going to be true? I guess it might be. It might not be. We won't know that until we go through a couple more of these up and down cycles. But as these up and down cycles, the lows get higher and the highs get lower, narrow, then these two lines converge. Maybe, 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 maybe. And what we said a long, long time ago is that we're following a model reminiscent of the 7-year cycle that was in that's when done 1986 to 96. Nobody can remember it, but that's what it was. And like nobody can remember in 1986 and 1987, the MLS system crashed. Now, I hope we don't have that on July the 31st when they implement the new thing, but it has happened before. Overconfident techies don't anticipate the demand that will come from all of a sudden 72,000 members using a new system and all the bugs then show. Like last week, the airports were affected and the banks. Anyway, so that's that one. Let's see if this plays out. We do not know. We've been predicting that the market could fall 30% from the peak. We're already at 17 off or 13 off, depending on the month. So it's okay. Well, that leads us to there's another one, the famous triangle. The famous triangle. Affordability. Everybody and his brother who's in the politics business talks about affordability. Now, what does that be? What is that and what is affected by it? Affordability, which is can I make the payments within the 30% guideline, is based on household income, the price of the houses, and the interest rate and amortization that the financing is done over. This is all assuming constant down payment. Down payment is also a factor. If you need 20% down to avoid high ratio insurance, then that's quite an amount of cash money if the average price is over $1 million. It's also quite a lot of money if the average price is $500,000, but nobody's really thinking about that. What are we going to have affect things the most? Will household incomes jump up by 50%? Not bloody likely. Will interest rates come down to where they were in the depths of the COVID craziness? Not bloody likely. Will house prices come down? Not bloody likely. So something has got to give. And we know what household incomes are going to do. We know what interest rates are going to do, more or less. And we know that house prices are controlled by the people who participate in the sales and listings and purchasing every month. So we will watch. Nobody wants to say the house prices are too high because everybody wants prices to stay up. I got a line of credit against that instead of a second mortgage. I am planning to give that money to my grandmother. I'm going to sell this at a big profit after living here underwater for a long time. So it's a terrible thing that nobody wants to talk about, but a few are saying house prices are too high. Oh my, well, how much should they come down? Should they come down from the peak? They're going to come down from now another 20%. We'll look at it and we'll make a prediction. But right now, from the peak is the only thing we're talking about is 25% off the peak is not unreasonable. And that's
Well, okay,
two
Robert.
lines converging, we're saying too.
Okay, so Robert, this is great analysis so far, but for the bystanders, speculators, and by
Yeah.
spec, I mean the ones watching on the sidelines, waiting for prices to go down, and for real estate haters, what will be the catalyst? Because everybody's waiting for it. Everybody's waiting for the bubble to pop, the crash to happen. If 17% isn't bubble popping or crashing, 30% might be. What do you feel? And I know it's tough to project these sorts of things, but as you said, a seller, for a market to happen, a seller buyer matches. And just like trading stocks, that stock will only drop down in price if buyer and seller agree that that's what that price is. What is it for real estate? Because real estate doesn't work as fast as a stock market. So will it take, everybody who's in mortgage arrears, everybody who owes money and can't afford to pay it anymore, and this long-winded journey to the bottom of interest rates, if that doesn't come fast enough for those who can't pay for their mortgages, when will we see the price drop, if that, and if we're following the 86 to 96 pattern?
Okay. In the stock market, you've got only one or two different kinds of buyers and kinds of sellers. So if we can bring up the thing that shows the categories. I was looking around for the original of this because I got to change the scenarios and I got to change the characterization of the five categories. But the five categories, the way they are right now, first time owner occupied buyer with nothing to sell. Now, that guy is not frustrated but learning. He's sitting on the sidelines waiting for someone to tell him that he's doing the wrong thing by waiting, and nobody's telling him that. Now, the last time owner occupied seller with nothing to buy, they're saying, well, I guess we don't have to sell this year. If we can't get $2 million, we can wait till next year. It doesn't cost us that much to live here. And, our plans aren't going to be that delayed. One time they're going to run out of time. Then number three, the buy and sell owner occupier. They're moving. They're looking around for someone who's really, really hurting, and they're putting it in an offer subject to the sale of their current home. And why wouldn't they get that accepted? They'll get it accepted because everybody, the seller, if they've been on the market more than 45 days, the agent, same reason, is saying, well, it's a better, lower price than yours and a better chance of selling. So they get the sole conditional on the sale of the purchase property accepted. Now, number four, investor underwater. We may talk about this later. Someone who bought in 2020, 21, 22, they're underwater. If they sold today, they would lose money. And so they are still frustrated. They're looking around for options, and all those options cost them a lot of money because they're borrowing from non-prime sources. So they are currently on the market. This is why the condos markets are flooded, because these people would lose money if they sold at the available price today. And then finally, investor in the money. If they sold today, well, maybe I'll keep it, maybe I won't. So you have only got a segment of the market that's participating. You got the buy-sell person, investor underwater. They're the one. That's why there's 6,000 condos. And the first-time buyer's not buying. He's supposed to buy the underwater condo guy. So nothing is going to trigger any particular segment more than the other. Everybody's looking after their own self-interest. And when it seems that interest rates have bottomed, then the prices will go up. But we're a long way away from interest rates bottoming. So we're going to have a market like we're seeing right now. When we look at the sales, we'll see it.
Now let's look at scenarios before we look at sales.
Okay, well, this is, if you look down the bottom, November 2023 is when I did the scenario. So I'm going to revise this slightly on what the rate projections are, but the best case scenario, I guess, still is that prices slide to 75% of peak. Now, nobody wants to hear that. We're at 87% now, and rates settle at 4 to 4.5% 5-year first. Well, maybe I don't have to change that. Worst case, prices slide to 50%. Everybody who is a real estate hater says, yeah, okay, now instead of it being 1.3, it's 700. Is that better? And rates fall to 3.5 by 4.5 to 4.5. Now, for rates to fall that low, we've got unemployment like crazy. We got the worst case of economy. We got all kinds. We got war. I don't know what it is, but we don't want the worst case for sure. And the middle prices slide to 65 to 75% of the peak, and rates settle at 5.5 to 6% for a 5.5-year five. Now, maybe those rates are going to be a little lower than what I thought in November of 2023, but a lot of water's gone under the bridge since then.
All right, now let's look at the biggest number that we've got to watch. Well, maybe not the biggest, there's a ton of them. What are sales looking like in July? I mean, we know inventory is hovering at 23 and change, 23,500, 600, 700, 800, depending on what time of the day you're looking at. But then if we don't see enough sales happening, then absorption rates gets affected, and that sort of sets the pace for the fall. What's July looking like, Robert?
July's fading. And as I said to my seller of the beautiful house that they took off the market, is that you're not missing anything. Anybody that's got any money is on holidays right now. So relax. If you can do some bridge financing, if you stall for time, you can do something or other, stall for time, wait for September. Not that September is magic, but you're out of the summer doldrums, and there will be a certain number of buyers who want to move before the snow flies. And so we will have a fall rally, and you can be ready for that. Now, At the beginning of July, it was looking like 6,000 sales, which was up from last year's 5,200. So last year was the 23rd best July. This year is the 22nd best July. And all of these numbers is 27, 30% off what the norms are. It's back to our regular pattern where we have been for the last at least year and probably closer to 2 years of 30% off the 5 and 10 year normal. Now, 30% off the 5 and 10 year normal, we got to remember is 5 and 10 years, that was a boom. So those are high numbers. So I've included now the 16 and 20 year, unfortunately, doesn't get any better. That we'll look at one later where we see someone who says, I've been in the real estate business for 25 years and I've never seen anything like this except for in 2008, the great financial crisis where they kicked the can down the road, but they kicked it down the road to now. And the thing is that anybody who's been in the real estate business since 2000, let's say 2000 or 1996 is what I call it, has only seen an up market. They don't know anything other than an up market. And the market that we're making the comparison to in that slidey one that we used before is 86 to 96, which was a very calm market, very calm market, prices dropping. Interest rates were much higher and they gradually came down, but nobody who has a real estate license now and is actively trading has ever been in a market like that. So they don't know how that works.
All right, so Real Estate Chat viewers, hang tight. Make sure you follow our episodes. And by the time you're watching this, interest rate announcement probably would have been made, and it has probably dropped a quarter point. I mean, if we're wrong, we're wrong. But stay tuned. Hang tight for the summer market. Let's watch and see what happens. And if you are in the market actively right now, make sure you do the right thing. That's for you and your family. Thanks for watching this episode of Real Estate Chat. Stay tuned. Take care and bye for now.
See you later.